Hey, John, it's that time of year again. Yeah, not Thanksgiving or the rest of the holidays, but time to do tax planning. That's where the action is with taxes. This is how you save money on taxes, is by looking at it now towards the end of the year. Hi, I'm Bridget Sullivan Ramel. I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shearer. I've got a fee-only financial planning practice in Middleton, Wisconsin. And before we jump into tax planning, I want to remind everybody to hit that subscribe button that helps other people find this information on YouTube. And with that, I was excited you mentioned Thanksgiving. I thought there was going to be some fun stuff, but there is the meat on the bone. This is where the rubber meets the road from a tax standpoint, right?
Yeah, and this is one of my favorite topics, actually, because I'm a nerd and because this can really help people. So once you retire, there's so much more you can do with saving money on taxes than when you've got I call it like the W-2 train coming into the station every year. This is like you have your own car. You just have so much more freedom, especially in the years before you take both Social Security and you have to take required minimum distributions. You have just a lot more flexibility, and I just love it. So let's talk. The first thing I like to talk to people about is how are they paying for their medical insurance? And so a lot of people are on Medicare and they don't retire until they're 65. So I'm not going to belabor this point, but some people are on the marketplace and they get a premium tax credit. And so when we're talking about these other great ideas that we have, you want to be mindful of your premium tax credit because that is extremely income sensitive and a nice benefit. So that I have found takes precedence over everything else. The other thing is that I don't know if premium tax credits are going to stick around for this group, and for pre-retirees like they are. And so because there will be tax changes towards the end of 2025 or maybe in 2026. And so take the premium tax credit while you can.
Yeah. No, that's such a great point that for folks, we have a similar experience to what you're describing, before you hit 65 and qualify for Medicare, right, to the extent you're paying for your own health insurance, getting it through the exchange, right, and the premium tax credit. I mean, we see folks, I'm sure you do too, that $500 a month, $1,000 a month, $1,500 a month in credit. Now you see that, of course, when you do your tax return, but we're talking like sometimes up to, in the neighborhood $18,000 a year in lower taxes based on, managing your income. And I don't know the exact numbers. I don't know if you do, but I know we've got some folks where somewhere in that $50-ish thousand of taxable income, to the extent we can keep income below that, that really ramps up those tax credits. And those things are just so, I mean, and remember, we're talking about credits, right? It's not deductions and things like literally your taxes go down by $15,000 because you're paying for health insurance and your income from a tax standpoint is at a low level. It's just such a great deal.
Yeah. So if you're taking that, pretty much what I've seen is going to override everything else. So that'll be a primary consideration. Okay. But after retirement, most people are not in that situation. So let's move on. The first thing let's talk about is IRAs. And let's talk first about tax brackets just for a second. So when you look at the tax brackets, first you've got a standard deduction. And then you've got the tax brackets, and you've got a 10% tax bracket and a 12% tax bracket. And those are very friendly tax brackets for the people who are just retired. And you might not be able to be in those tax brackets once you start taking Social Security and you end up taking required minimum distributions. So you want to take full advantage of those tax brackets now. What are your thoughts there? How do you work this?
Yeah, absolutely. It's one of those things where having zero tax, right? That sounds really good. And we've got somebody that we've been done some work with, and they've got some extra medical expenses, right? I mean, some pretty significant ones. And we took a look at their taxes for the year, and they would owe zero taxes because of these massive deductions that they have, right? For some long-term care issues, those sorts of things, which sounds fantastic,
Right.
except for you go, wait a minute, having zero taxes isn't as good as it sounds when you think about in the future, these folks are going to have to take money out of their IRAs, and it's going to be whatever, and they have these minimum distributions, and those can get pretty, pretty substantial. And you go, listen, why don't we take some money out and pay that 10% tax rate, at that 12% tax rate? And it's, even though we're intentionally paying some taxes we don't have to, golly, that low rate, and the question becomes, what are the chances that either you or your heirs, somebody that inherits your IRA type money, what are the chances they'll pay less than 10% or 12% in taxes, right? Not zero. I mean, there's a chance,
Right.
but for many of our folks, you go, oh yeah, when my kids inherit this money, they'll be in their 50s or 60s or something. Shoot, I bet their tax bracket's going to be that level or higher. That's where, taking advantage and being intentional about sort of smoothing out the tax brackets, right? We don't want to see 0% now and like 24%, when we're in our 80s. If we can keep it at that 10 or 12% over time, that's a much better deal.
Right, right. So this is going to mean that you're going to need to make some projections.
That's right.
So the other thing is there's two ways to take money out of the IRA right now. You can either just take it out if you're going to need it. That's what, like I saw, I have some people, they don't have too much money in taxable accounts, and so they live off their IRAs. Yeah, and that's a lot of people, right? And so you might not need any money right now, but you could take it out and be in the 0 or 10% bracket. Why not?
Right.
Especially if you're going to be in a higher tax bracket later. So you can just take the money out. Or if you're like, well, I'm not going to even need this, then do a Roth conversion. And you might not even have a Roth account because a lot of people don't. But a Roth conversion means you put it into a Roth IRA, and then once you meet the conditions, which are keeping it in there for 5 years, it's tax free. It doesn't grow, So it's moving from a pocket that has a hole in it to a pocket that doesn't have a hole in it. That's
Yeah. And just to be clear on that, when we do that conversion, that's called, right, we take money from our regular IRA, put it into Roth, we pay taxes on that money, right? So we're paid, tax on $20,000, $50,000, $100,000. But then once it's in the Roth, then going forward, all the growth is tax free, subject to those rules, right? So that's the deal, is right, controlling the timing. And you described it at the beginning of this episode, Bridget. When you're working, you get your income. You don't have a lot of control typically over when money comes in. Now in retirement, you've got control and can make some decisions and be intentional about when do we pay these taxes. Not like we can avoid them for the most part, right? Usually IRA type stuff, we're paying taxes on that money, but you can control the timing, which is a really, really powerful tool in your financial planning belt.
Right. So if you're going to need the money, I would say in 5 years, take it out just as a Roth IRA distribution. If you're not going to need the money for 5 years, just take a distribution and put it in a Roth.
Yep.
That's pretty simple. And I would say that there are cases where you can pay zero tax if you have income low enough so that you're still in the 0% bracket. If you're just meeting the standard deduction or your itemized deduction. So if that's a possibility, you wouldn't have a huge withdrawal. Okay. So that's our first, is Roth conversions and Roth distributions. Number 2, capital gains and tax gain harvesting. So usually we talk about tax loss harvesting. Okay. We didn't really talk about it too much this year because guess what? The tax not
too many losses.
We're not seeing a lot of losses in portfolios. Stock market's been up all year. So we didn't even talk about that in our last episode because we've been both doing these and we're not seeing a lot of losses. But you can do tax gain harvesting, especially when you're in these brackets. So what say you?
Yeah, I mean, and well, just to explain what that means, tax gain, right? It means intentionally selling things, an investment that's gone up, right? We put in a $10,000, now it's worth 15. We sell that, we've got $5,000 in gains. which in most circumstances is unappealing. Geez, I don't want to pay taxes on that. But when your overall income is at a low enough level, the capital gains tax rate is actually zero. Right? It's my favorite tax rate. So is it taxable income? Yep, it is. And the rate that gets applied when you're in those lower two brackets, the capital gains rate is zero. Right? So why not take something that, again, in the future, if I'm in a higher tax bracket, I sell those things and I pay 15%, let's say, capital gains tax. Today I can take those same profits and pay zero tax. Again, that's, our favorite tax bracket, zero, right?
Right. Yeah, and I think most clients are there too. So the thing is that for most people, we would prioritize IRA distributions over capital gain harvesting. And it depends on how much they got where and what the positions are in their portfolio. If there's things that we really just don't like and we want to do some tax gain harvesting because we'd really rather be in different positions, that we might do some tax gain harvesting in that situation if they had a large IRA as well. But usually if somebody's got a big IRA, we just favor that versus the capital gains harvesting. And the biggest reason is that the rate is lower anyway. Once the capital gains rate is lower anyway, once you do realize capital gains, even if you're in the 22 or 24% bracket, and you get that step up in basis if you pass away. So your heirs don't have to pay tax on it, where your heirs will pay tax on receiving an IRA deduction or an IRA.
Yeah. I like, as you said, your mileage may vary, right? Like unique circumstances, everybody's different, but in general, I agree with that. Is when we have got low tax years, taking money out of IRAs, because that's going to get taxed to somebody, almost certainly, right? A few exceptions, but pretty much that's getting taxed at regular income rates. Then the next step is, hey, can we take some capital gains that if we can take them for free, why not take them for free, right? That's the right way to think about it in my mind.
Now, I think a lot of people are thinking, let's get this party started, right? Well, how can I do this? But we're gonna put a little bit of a lid on our party, okay? And I've got two lids on the party. The first is if you're taking Social Security, the way that Social Security, that is not taxable at all. When you're at low income, and then it gets up to 85% taxable really quickly. Within like $10,000 or $20,000, it goes from zero, like of other income, it goes from zero to 85% taxable. So your amount of income goes up fast. So when you're doing these calculations, you want to have an idea of if you're taking Social Security, how you're influencing that.
Yeah, that's a great, but you can't just say, well, here I'm in this tax bracket, because that can change the Social Security tax. We had somebody that we were working with and said, hey, let's take, I can't remember, it was Roth IRA conversion. Great. Keep you in the 10% tax bracket. The effective tax on that was 30% because it kicked up the Social Security income amount that was taxable, right? So you have to run the numbers. You have to look at the projections and actually do the return in order to see that.
The other thing with a party, like say you're not taking Social Security yet, is if you are on Medicare, there's those IRMA numbers. So how much you have to pay for Medicare varies based on your income level. And so you want to double check that chart. I think for a married couple, what comes to mind is that for 2025, it's like over 200,000. So there would be a lot of, but it's something to just consider. It's another thing we look at to make sure, okay, we're not doing all this fancy stuff and then tweaking this so that we're paying a lot extra in Medicare premiums.
That's right. Pay attention to Social Security taxation, pay attention to those Medicare premiums as you're looking at these strategies to take advantage of low tax income years. I think it's a great place to wrap things up here. Again, I'm John Shear. I run a fee-only financial planning practice in Middleton, Wisconsin.
I am Bridget Sullivan-Mermel. I've got a fee-only financial planning practice in Chicago, Illinois. John and I, the way we met is through an organization. It's a not-for-profit group of fee-only financial planners called the Alliance of Comprehensive Planners, or AC Planners. And so we're both taking clients, but if you're looking for a planner in your area that kind of thinks how we do, check out acplanners.org.
And don't forget, hit that subscribe button.